Welcome back to The Explainer. Okay, today we are tackling a really critical intersection in modern finance. With billion-dollar weather disasters kind of just becoming the norm now, we're at this point where abstract climate threats absolutely must translate into concrete, actionable mortgage risk models. If you're a focused learner looking to understand exactly how the biggest institutions are completely rewiring their risk analysis, well, you're in the right place. We're going to look specifically at the SASB framework for mortgage finance, specifically those environmental risk metrics. Essentially, we're taking the huge concept of climate change and breaking it down into hard, quantitative math.
And the SASB framework, it really doesn't mince words about this threat. It states right here that extreme weather events have the potential to result in missed payments and loan defaults, while also decreasing the value of underlying assets. So, this isn't just about environmental stewardship. This is a massive macro threat to portfolio value. We are talking about an immediate quantitative hit to the bottom line. When extreme weather strikes, borrowers miss payments, properties get damaged, and collateral value drops. Lenders have to know exactly where that exposure lies.
Okay, let's dive right into this. Here is our roadmap for today. 1. The climate mortgage threat. 2. Mapping 100-year flood zones. 3. Modeling expected loss and LGD. 4. Weather events by region. And 5. Rewiring underwriting and valuation.
Section 1. The climate mortgage threat. So, before we get into the heavy math, we've really got to understand the foundational philosophy here, which is value creation through transparency. The framework explicitly points out that entities incorporating climate-related risks into lending analysis are basically just better positioned to create value over the long term. And that's the entire goal, right? By tracking environmental risk transparency, institutions aren't just ticking some compliance box, they're actively protecting shareholder value from unpredictable severe weather shocks.
Moving on to Section 2, mapping 100-year flood zones. We know the threat exists, for sure, but how do we actually locate our baseline exposure? Well, we have to start with a very precise definition. A 100-year flood zone is defined by SASB as a land area subject to a 1% or greater chance of flooding in any given year. Under metric FN MF 450A.1, lenders are literally required to disclose both the absolute number and the total value of their mortgage loans underwritten on properties located within these specific, mathematically defined zones.
To really bring this definition to life, the standard gives us some concrete examples of what these zones actually look like in the real world. We're talking about coastal floodplains stretching along major rivers, and areas that are uniquely subject to flooding from ponding in low-lying topographies. Basically, if a property sits in one of these areas, it carries that 1% or greater annual risk, and yep, it absolutely must be tracked.
But here's where we need to be incredibly precise, especially for the risk modelers tuning in. Which assets actually go into this calculation? Notice the super strict criteria here. You include first mortgages on 1 to 4 family homes, plus junior liens, like home equity lines of credit, that your entity actually holds as loan assets. However, and this is a huge distinction, you exclude mortgages held for sale, you exclude mortgage-backed securities, and you completely exclude mortgages that your entity merely services. You are only calculating the flood zone exposure for the loans sitting actively on your own balance sheet.
All right, Section 3, Modeling Expected Loss and LGD.
Okay, so we've mapped the properties. Now comes the big so what question. What happens to the math when that 1% flood actually hits? The first financial pillar we need to break down for metric FN MF450A2 is loss given default, or LGD. SASB defines LGD as the share of an asset lost in the situation of default, expressed as a percentage. Think of it like this. In the context of a natural catastrophe, if a massive storm wipes out a property and pushes that borrower to default, what exact percentage of that collateral's value are we actually going to lose?
And calculating our second pillar, expected loss, well, that requires a pretty systematic step-by-step formula. First up, you identify the value of a possible loss for a mortgage loan. Second, you multiply that value by the probability of that specific loss occurring. And finally, step 3, you sum up all of those values across your relevant mortgage loans. That final sum gives you your total expected loss attributable to weather-related natural catastrophes. It basically turns the total unpredictability of nature into a hard, modeled financial figure.
Section 4. Weather events by region.
So what exactly counts as a catastrophe? SASB breaks down weather-related natural disasters into 3 really distinct categories. First, meteorological events, and that's going to include things like hurricanes and storms. Second, hydrological events, which specifically covers floods. And third, climatological events, which broadens the whole scope to include heat waves, cold waves, droughts, and wildfires. When you're in there calculating that expected loss in LGD, these are the specific types of hazards you are modeling for.
Now, a really critical modeling distinction here. You've got to know what to leave out. The standard explicitly states that geophysical events are totally excluded from these weather-related metrics. Because earthquakes are fundamentally geological, right? They aren't driven by atmospheric weather or climate, so they just do not belong in your climate risk calculations. So no, you don't have to model your mortgage portfolio for a sudden volcanic eruption.
Let's see how all this data actually comes together in reality. SASB requires institutions to break down their total expected loss and their LGD percentages by geographical region. You don't just provide one massive, vague number for your whole portfolio. No way. You segment it. You decide the applicable regions, and you model the localized risk. For example, Region A might have huge hurricane exposure driving a specific LGD, while Region B might face high wildfire risk. Segmenting by region is what provides true transparency to investors about exactly where a portfolio's vulnerabilities actually lie.
Finally, Section 5, Rewiring Underwriting and Valuation.
This is where the numbers finally come off the spreadsheet and actively change how a business operates. I mean, how do risk modelers actually integrate these loss calculations back into qualitative business decisions? The standard asks institutions to describe how environmental risks affect their origination models across two major fronts: collateral valuation and credit risk analysis. On the valuation side, how does the risk impact the physical asset itself? Are you accounting for inherent location risks, and are you actually assessing whether the property has basic adaptive measures, like reinforcement or hurricane shutters? Then, on the credit risk side, the analysis shifts to the borrower's financial resilience. Does your model assume that increased disaster frequency will raise the likelihood of default simply because properties are uninsured or underinsured? It's a completely dual-pronged approach to risk.
To sum it all up, this framework requires some very concrete changes to the origination process. Institutions absolutely must incorporate the increased frequency and severity of weather events into their thinking. They've got to assess inherent location risks up front, they must evaluate the presence of physical adaptive measures, and crucially, they have to model the likelihood of default based on a potential lack of sufficient insurance coverage. Think about it. If a massive storm hits and a borrower is underinsured, the lender is the one left holding the bag.
Wow, we have covered a tremendous amount of ground today, right? From identifying 100-year flood zones to calculating expected loss percentages and finally rewiring the entire origination pipeline. But I want to leave you with this final kind of provocative thought to take back to your own teams. Are your current portfolio models truly prepared for a future where 100-year events happen way more frequently? Really think about how these SASB metrics might reveal hidden vulnerabilities in your own data. Thanks so much for joining me on this deep dive in the Explainer, and I'll catch you next time.